Our future decisions will ensure that the key ECB rates will be set at sufficiently restrictive levels for as long as necessary to ensure such a timely return. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions.
Thank you, President Lagarde. And the first question goes to Lefteris Papadimos of Reuters. Lefteris, please.
Hi, President Lagarde, what role did the recent weak economic data and the war in Gaza play in today's discussion? And secondly, did you discuss or at least begin talking about ending PPP reinvestment earlier or raising banks' reserve requirements?
Thank you very much. And let me take the opportunity of this first question to really express our appreciation for the extraordinary hospitality that the Greek National Bank, but also the Greek people that we have met here and there, have really deployed on the occasion of this visit. It has been a stellar organization and a tribute to the capacity of Greece in general to organize things and to make us feel welcome. So, Ekaristo. You ask me, I will start with your two last questions because in a way they are the most easy ones. Neither of these two questions, nor the PEP, nor the remuneration of required reserve, have been discussed at this meeting. You ask me about the current geopolitical environment and how that has weighed on our decision. I think we repeat 2 or 3 times in the context of this monetary policy statement the risks posed by the geopolitical environment and these aggravated risks as we see them unfold and develop. And of course, you have a special sentence in the MPS that refers specifically, in addition to the totally unjustified war of Russia against Ukraine, which refers to the tragic development as a result of the terrorist attack on Israel. We are monitoring the situation. We are very attentive to the economic consequences that that could have, whether in terms of direct or indirect impact on energy prices or the level of confidence that economic actors will continue to display. Thank you.
Thank you. And the next question goes to Annette Weisbach of CNBC. Annette, please.
Thank you, Madame Lagarde. I have 2 questions. I think on many people's mind is the question, how long is actually sufficiently long, and what will make you rethink and perhaps cut rates at one point in time? Is it at 2% inflation? Is it at 2.5? Is it at 3? I think that is something the market is interested in. And then my second question goes on your comments about the yields, which are on the rise as well in the euro area, and you said from other jurisdictions or from other regions, you're probably referring to the United States. So are you concerned about that rise in yields as well, and also about the potential fragmentation here? Thank you.
Thank you very much for your 3 questions, if I counted right. Huh? So how long is sufficiently long? You know, obviously we refer to timely manner, sufficiently long. But in the same breath, I say we shall be data dependent. And at this point of our fight against inflation, and after 10 successive hikes, now is not the time for forward guidance. Now is the time to really stick to our data dependency knitting, if I may say. And we shall do so. We have acknowledged on the occasion of this meeting that our assessment is confirmed, the assessment that we had in September. All numbers, if anything, have reinforced our assessment of the situation. We have applied the 3 criteria that you all know well, the inflation outlook, duly informed by any information that we have, the underlying inflation in all its compositions, and the strength of the transmission of monetary policy. So we will continue to be data dependent. Your second question was essentially when and at what level do you cut? This was not discussed at all, and the debate would be absolutely premature. You know, we have acknowledged in our review of the macroeconomic situation back in September and yet again this time around, and we all know, and you know, that labor cost, wages, profit units, the analysis of that is critically important to determine the inflation outlook. And we will continue to accumulate data. On labor, for instance, we are going to have a wealth of numbers and data and intelligence when collective bargaining agreement and annual negotiations in 24 will be completed. That is way into 24. That's only a for instance. And, you know, even having a discussion on cut is totally premature. For the moment, what we're saying is that we have to be steady, we have to hold. This is the decision of today. We are holding. Okay, so your third question had to do with this sort of external tightening, which is not directly relevant to the fundamentals of the euro area economy, but which are tightening element nonetheless, because they directly impact on how long-term yields and long-term rates as well. So that definitely is a spillover that we take into account, and that is compounded with other elements that clearly are bringing inflation down.
Thank you, President Lagarde. And the next question goes to Alex Weber of Bloomberg News. Alex, please.
Good afternoon. Thank you for taking my question. You said that you're seeing strong transmission of your past rate increases to financing conditions. Can you say how much of the impact has yet to hit the real economy and then on inflation? And then secondly, a follow-up on energy costs. I'm trying to understand how you would react to another spike in energy costs for example, as a result of conflict in the Middle East. Would you take the recent inflation episode as a lesson and immediately react to that, or could you afford to wait for second round effects?
Thank you. Those are interesting questions. I'll start with your second one, which is essentially, have we learned anything from the last energy crisis, the impact it has on inflation directly and indirectly, and would we apply the same approach? This is work that is ongoing and that we will continue to do. But it's clear to us that it applies to a completely different economy today, and an economy which has had an episode of very high inflation, an economy where the interest rates is at a very high level of 4%, and an economy that has strong employment and which is weakening. So we have to take all these factors into account to see how possible higher cost of energy would actually affect both GDP and inflation. And it's in the context of that assessment that we would respond accordingly. But be under no doubt, our determination is intact, and our determination to bring inflation to 2% in the medium term is absolutely the same, if not reinforced by the proximity of the destination. Your first question was the...
Strong transmission of...
Oh, yeah, of course. So what we are seeing is a very strong transmission of our monetary policy in the banking sector in particular. And the financing of the economy as a result is directly affected, which in turn plays onto the reduction of inflation and the dampening of demand. And those numbers are really, you have seen the bank lending survey, I'm sure, and they are very striking in terms of both volume and rate transmission. We know that there is still more to come. So as is often the case with monetary policy, there is this transmission lag time. The assessment by our staff is that there is still more in the pipeline and more to come to affect the real economy. And the assumption is that it will continue to unfold throughout the end of 23 and first quarter of 24. Now, one might argue that it's going to last longer, but we have already seen a significant transmission to the financing conditions. More is to come. And if you look at, for instance, the housing sector, it's pretty obvious that there is transmission to the real economy. If you look at the volume of capital expenditure, of investment by corporates, there is a reduction. It's not just the banks telling us that they will be more attentive to the risk and that they are reducing their flow of credit. It's also the corporates that are putting a brake on their investment because of the level of interest rates. That clearly results from the various corporate telephone surveys that we conduct and from the bank lending survey as well. So both in the housing sector and in the investment numbers that we have, it is transmitting to the real economy.
Thank you. And the next question goes to Eleftheria Kortali of the Greek website Capital GR.
Hello. President Lagarde, I would like to ask you a question on spread widening. Have you at all discussed spread widening, and especially the case of Italy? Italian spreads are now above 200 basis points, and I was wondering if this is a level the ECB is comfortable with, or it is considered to be a level of significant widening. And my second question is on Greece. Are Greek bonds now back to the ECB's normality? That is, are they now eligible for every purchase program when and if they are ever activated again? And are you confident that the Greek economy can return to normality? That is, where it was before the debt crisis, when it was rated A and A+ even? Thank you.
Thank you very much for your question, your two questions. Let me turn to Greece first and remind you that we only have one active purchase program that is operating at the moment, and that's the reinvestments that we conduct under the PEP. Under APP, we don't do any reinvestment anymore, so there is no question as to which country is eligible or not eligible. So Greece was eligible to PEP under a special waiver that had been decided at the time. Well, the good news is that the waiver is irrelevant. Greece does not need any waiver. The Greek instruments are eligible to PEP without any exceptions. So that's point number one. Point number two, Greece is now back to pre-COVID situation, and I speak under the control of my colleague and friend, Governor Stournaras, but Greece is actually higher than the level where it was just pre-COVID. And if I comparisons are odious, but I will make an exception. Greece compares extremely well with other countries. And I'm saying that because we're in Greece. I'm not going to, comment any further on who is better, because I don't want to comment on country-specific situation. I'll look at euro area numbers, but we are here in Greece. And Greece has demonstrated phenomenal recovery capacity, and it is, if I recall, 10% above the pre-COVID level at this point in time now. So I don't know what is normal or abnormal, but I have to say that it's a stellar performance. Would you like to add to this? And then I'll come back to your first question.
I fully agree, President, with what you have said. On activity, we're about 10% higher than the pre-COVID situation. The GDP growth is much higher than the average of the Eurozone. Spreads, they are within a range which we think it is quite normal. So all in all, it's a success story, as the President said in her press conference. But also, I do not deny that still there's a lot to be done until we get back to a rating of A+, as you said.
So on the first part of your intervention, let me remind you what we do. Our mission is price stability. We have defined it in our strategy review as 2%. We are not at 2%. The best tools that we can use to return inflation to 2% are our interest rates. And this is what we are using, and I just want to mention that the fact that we are holding doesn't mean to say that we will never hike again, okay? So at this point in time, on the basis of the data that we have, we are confident that the rates at 4%, well, I should say, the three rates at the level they are contribute substantially to bringing us back to 2% in a timely manner. But we are data dependent. Second point is that in addition to our stance, we also have to make sure that there is proper transmission of our monetary policy throughout the whole euro area and to all countries in the euro area. And we have all the adequate tools in order to make sure that that happens. Thank you.
Thank you, President Lagarde. And the next question goes to Martin Arnold of the Financial Times. Martin, please.
Thank you very much. President Lagarde, two questions from me. The first question is about central bank losses. So we've seen this week that the Riksbank, I know Sweden's not in the Eurozone, but the Riksbank has warned it will need 80 billion Swedish krona from the government to repair its balance sheet. Do you expect any Eurozone central banks to need similar kinds of capital injections? And the second one I'd like to ask is about PEP reinvestments. What's your view on the various calls we've heard from members of your governing council to say that those could be, the end of those reinvestments could be brought forward? Do you think that would be a risky move? Thank you.
Thank you very much for your two questions. So on your first question, I will not go into the specifics of each and every national central banks, because they are all in a different situation. Some of them are publicly quoted institutions, others are not, and there is no one-size-fits-all for the situation they're in. What I know is that as a Eurosystem and as ECB, we have one mission, which is price stability. And we do not have as a purpose to show profits or to cover losses. And it would be actually wrong if our decisions were guided by our P&L accounts rather than for pure monetary policy purposes in order to bring inflation back to 2% in the medium term. On your second point, as I said earlier, we have not discussed PEP on the occasion of this meeting. Thank you.
Thank you very much. And the next question goes to Silvia Berzoni of the Italian TV program Class CNBC. Silvia, please.
Good afternoon to all, President. Do you think that given the vigor of the monetary policy transmission and the added uncertainty of the war between Hamas and Israel that you just mentioned, ECB economic forecast might be a little too optimistic? Thank you very much.
Well, thank you so much for your question. I'm tempted to give you an appointment for our next monetary policy meeting, because obviously in December we will have a whole range of new projections, new numbers, and as is often the case, we revisit either up or down, depending on the situation. And once again, we're going to be purely data dependent. What we know for a fact is that growth has weakened. And if we look at PMI numbers, for instance, they are not indicative of a very vigorous growth, which is why I have clearly indicated in the monetary policy statement that growth continues to be weak.
Thank you. And the next question goes to Eric Albert of Le Monde. Eric, please.
Thank you very much. Good afternoon, Mrs. Lagarde. Just again, coming back on the bank lending survey, what you mentioned several times, the economy basically stagnates. I mean, is there a risk, are you worried that you've just been too far? Yes, the transmission will be slow, but you might have gone too far. And that's just one question, actually.
Yeah, it is one question.
Sorry.
No, that's okay. Well, I can only repeat what we say, and we actually repeat in the monetary policy statement, which is that we believe that the three rates where they are, if kept for a sufficiently long period of time, will actually make the contribution that is needed, the substantial contribution that is needed to return inflation to 2% in the medium term. And what we did on the occasion of this monetary policy meeting was to compare the September that we had in September when we made our decision, the new data that came in, including the inflation number, headline, and core inflation, including the bank lending survey, notably, and the various flash estimates and PMI numbers to confirm the assessment that we had previously. And let's not forget, our mission is to return inflation to 2%, to make sure that inflation does not cut into purchasing power of people.
Thank you. And the next question goes to Leonidas Exotsidis of Handelsblatt here. Leonidas, please.
Good afternoon. Thank you. I would like to come back to the rising bond yields again, please. There is the point of view that the rise in the bond yields helps the central bank in the transmission of the monetary policy as financial conditions become more tightened. On the other hand, there are also people arguing that it can become a risk for the financial stability. Do you agree with both points of view? And do you think it can become more difficult for you to find the right balance in the future? Thank you.
Thank you. I'm going to share your question with the Vice President because he's the real expert on this panel on financial stability. But I just want to, again, remind you of what I said about the rising bond yields. This is a movement that originated outside the euro area. It is not directly related to the fundamentals of the euro area, and it is different, but we are facing the same circumstances that we feared back in March at the time of the various regional banks and Silicon Valley banks and Signature and First Republic collapses, where again there was spillover and the fear of more of it. But this is something that clearly impacts our own rates, and we take that into account.
Good afternoon, everyone. Well, in a couple of weeks, we are going to release our financial stability review. The financial stability review, is the document where we indicate the main financial stability risks that we have here in the euro area. And I would say that the increases in yields is something that we are looking at very carefully. Why? Because the main risk that we have identified in the past, and that it will continue being identified in the near future, is very high valuations of different kinds of assets. And we have seen that when you look at these valuations, not only financial assets, as the President indicated before, we refer as well to the real estate market. Well, the increase in yields can give rise to an important correction. So this is something that we are taking into consideration very, very closely. And simultaneously, other factors that, the higher yields can have an impact, mainly on the non-bank financial intermediaries. There we have seen that there is a concentration of potential vulnerabilities in terms of liquidity risks or liquidity mismatches, in terms of credit risk. And this kind of situations that you have an important and pervasive increase in yields can give rise to additional problems for this part of the financial system. That is not totally isolated from the rest of the financial system. It has important liaisons and links with the banks. So the increase in yields is something that we are considering very closely. And we will make a lot of comments with respect, in our financial stability review about the potential impact that this might have in terms of financial stability.
Thank you, Vice President. The next question goes to Michalis Psilos of the Greek daily Naftemporiki. Michalis, please.
Thank you so much. Mrs. President, now that Greek bonds are eligible, as you said, would they be included in your APP portfolio? Should you pause QT and start reinvestments? That's for sure. And the second question, once upon a time, I would like to say the concept of saving was very important, but in most euro area, like in Greece, deposit rates are almost zero, and of course, well below from inflation, while lending rates have increased considerably. How do you comment on that, and what can be done to change this situation? Thank you.
Thank you very much for your two questions. On the first one, I'm tempted to tell you that I don't want to deal with hypotheticals. We are in a process of fighting inflation, of bringing it to 2%, using predominantly the interest rates and ancillary additional component that come as a complement, such as the gradual reduction of the balance sheet, as we have seen as a result of TLTRO reimbursement, as a result of non-reinvestment of APP. But I'm not going to, have hypotheticals about what if after tightening, blah, blah. Suffice to say that Greece is today eligible to the PEP without any waiver. So it's, pari passu. Everyone in the group, the 20 member states, are in the same situation from that perspective. You asked me about the rates and the obvious gap between the lending rates by banks to corporates and to households and the remuneration of deposits. Our job at the ECB and at national central banks is to set the rates at which banks and other institutions finance themselves. Our job is not to set the rates at which they lend. We hope that they transmit that properly because that's part of the transmission mechanism, nor the rate at which they remunerate deposits. And this is an issue that occurs in several euro area countries, to which solutions are brought by either the authorities or by the power of consumers themselves or by the competition authorities. But this is not an area where the ECB or the National Central Bank can actually take action.
Next question, Andrés Stumpf of the Spanish daily Expansión. Here.
Thank you. Madam President, you're a few days away from finishing the first half of your mandate. I was wondering if there's anything you regret from these 4 years, and also if there's something that makes you or have made you especially proud. And a second question, if I may. In Spain, the political parties are trying to form government, have proposed extending the new extraordinary bank taxes. And when the tax was announced, the ECB published an opinion advising against it. Should we expect another opinion, or have you got anything to say about this topic at all? Thank you.
Thank you for your personal question, and rest assured that I have no regret okay? I'm not going to sing it to you, but there is a famous French singer that has done that much better than I could ever do it. So no regret. You know what happened today? One of our members, after 12 years of loyal and good services, finished his term on the Governing Council, and it was his farewell Governing Council meeting. The level of warmth, of emotion, of acknowledgement that was demonstrated to him, and his response, you know, reminded all of us around the table that sometimes we disagree. By the way, we had a unanimous decision on this occasion, just in case any of you is interested. Thank you. So while we disagree on occasions, because there is this common drive for delivering on the mission, we have a quality of debates, of exchanges, of different views. We try to convince each other on occasions, and we sometimes manage. That is something that is to be cherished. And in a world where, for dissenting opinions, people go into totally unconsensual and irrational directions, it's a gem. So that's for my personal take. I will not get personal again. That was it. So on the tax, maybe my Vice President.
Our assessment about bank taxes is well known. We have always said that this kind of levies, this kind of taxes should not impair lending, should not impair credit growth, and should not damage the solvency of the banks. That was the recipe that included in our opinions for taxes that were approved in the case of Lithuania, Spain, and Italy. Well, in the case of Italy, we had different versions, no? And the final one, I have to say that it was more reasonable, no, in that terms, because they indicated that if they increase the capital buffers, then the tax will be reduced. So this is the approach. So I don't know whether what's going to happen, with the Spanish case, whether it's going to be extended or not. So let's see. But the principles of our assessment with respect to this kind of taxation is quite clear.
Thank you, Vice President. And the last question today goes to Klaus-Rainer Jackisch of ARD Television. Klaus-Rainer, please.
Good afternoon. Thank you very much for taking my questions. Mrs. President, some people speculate that we've seen the height or the peak of the current interest cycle. Can we interpret this from today's decision?
Sorry, the peak of what?
Of the interest cycles. Can we interpret this from today's meeting, or is still everything open? And the second question you have already answered partly. Can you give us a little bit of insight of the debate today? From the protocols of last meeting, one can get a bit the impression that the differences between the different groups of the Governing Council may have perhaps be a bit stronger than in the past. Is this interpretation right? Thank you.
Typically when you reach by unanimous consent a decision, you don't have a widening of the differences. And, together with colleagues who have been participating in all these hours of discussions here in Athens, I can assure you that there was a general, well-shared assessment of the current situation, the judgment that we have made, and the monetary policy decision that we took, which, after 10 different hikes over the last 15 months, is for the first time a hold. So it's, sometimes inaction is action, and a decision to hold is actually meaningful and was taken by total agreement of all governors and members of the Governing Council this morning. So if any of you wanted to add to that, but I think you have either a misinterpretation or strange information from inside our discussion. We were inside the rooms, and I can assure you that it was strong. Do you want to add something, Yanis?
No, I fully agree with what you said. It was a unanimous decision.
And as to your question on peak, I'm not going to pass a judgment to say that we are at peak. we are data dependent. And we are going to, meeting after meeting after meeting, assess on the basis of the 3 criteria of the inflation outlook, of the underlying inflation, and the strength of our monetary policy transmission, whether or not our interest rates are delivering sufficiently in order to help us reach the 2% medium-term inflation. Thank you very much.
Thank you. That's all for today from Athens. Next time is the 14th of December in Frankfurt. Until then,
this is Bloomberg's The Open. I'm Lisa Abramowicz in for Jonathan Ferro. We have been listening to the press conference with Madame Christine Lagarde, which seems to be taken as a dovish pause, most broadly by analysts. In markets, you could see that she has declared victory when it comes to delivering a press conference that didn't rock the boat too much. Things basically where they were pre-trading session. You could see the S&P down just about 0.2% less than that. NASDAQ down similarly, climbing back from some of the losses from earlier. The euro really was what I was watching throughout all of this. And what you could see is a bit of stasis there, still at that 105 handle as people parse through all of this. Yields marginally lower. The message seemed to be, frankly, consistently that we're not necessarily at the peak, but the market was saying basically you are done. Outside of stocks, you can see broadly throughout the asset classes a feeling of pause, not just at the ECB, but also at central banks more broadly. You can see across the board 10-year yields, 30-year yields in Germany, in Italy, in the U.S., all lower on the day. I do want to get to President Lagarde speaking on some of the issues, in particular the latest ECB decision.
The Governing Council today decided to keep the 3 key ECB interest rates unchanged. The incoming information has broadly confirmed our previous assessment of the medium-term inflation outlook. Inflation is still expected to stay too high for too long, and domestic price pressures remain strong.
Bloomberg's Maria Tadeo joining us now from Athens. Maria, was this essentially a dovish pause, because that's how it's being interpreted?
Look, I think there are many elements that you could argue and say, yes, it was. Because on the one hand, you look at the decision. Obviously, they decided to hold. It is significant because we had been looking at this very aggressive hiking cycle from the European Central Bank. Also, when you look at the details in that statement, she said that there was no meaningful discussion around the PEP reinvestment. Remember, some had suggested that maybe they could bring it forward. As it stands, it should run until the end of 2024. There was no changes to that. She was also asked a number of times, what about the assessment of the overall economy, and pointed to the downside risks. She also said, as you noted, not a victory on inflation, but she did say the monetary policy is working, the transmission is working, but also it will intensify. She talked about Q1 of 2024. A lot of this, you put it together, you could say, yes, it was not just a hold, but a dovish one from the European Central Bank. There were a number of comments, however, that she made that you could argue she tried to balance it out, but to me, they felt a little bit off script, where she said the fact that we're not hiking today doesn't mean we're not going to hike in the future again. She also said, I'm not going to tell you where the peak is, but obviously, as some would say, it would be unwise for the European Central Bank to do that. But to me, it really did feel a central bank that is now turning the page into fully this debate of higher for longer. So this is not a question anymore about how many more hikes, but how do you sustain it and for how long? And that will be, I presume, the fundamental question. What is restrictive enough? It seems to be as it stands, but how long restrictive enough will be the question for the European Central Bank going forward.
Maria, great work as always. Maria Tadeo, thank you so much joining us from Athens. Joining us now to try to parse through what lower, higher for longer really means and whether this sets the tone for next week's Fed meeting is Invesco's Alessio DeLongis and Winnie Caesar of CreditSights. Alessio, I want to start with you. What was your takeaway from the press conference?
My takeaway is that this was absolutely the right decision. I do share the importance of looking at the information from the bank lending service, and they're clearly transmitting that information, that monitoring transmission is in place, and is probably even stronger than was initially anticipated. Loan growth, credit demand is coming in well below what was expected 3 months ago. So the pause, higher for longer, and the wait and see approach is the right one. What will be at the end of this wait and see approach? I think ultimately we'll find ourselves sometime in late 2024 contemplating or already delivering rate cuts, and it will be probably driven by inflation surprising to the downside and coming in below below the 2% target in the 2 years projections.
And that seemed to be what she was trying to avoid talking about, saying that that was not the case whatsoever. Winnie, your take on how much the ECB just set the tone for the Fed next week versus a completely different economic backdrop with very different concerns?
That's a great question, Lisa, and thanks so much for having me this morning. We have expected that the Fed is going to hold at its next meeting, but maintain a very hawkish narrative, which I think would be a bit different than what we just saw with Lagarde at the press conference for the ECB. The economic data in the U.S. has been quite resilient as of late. We've seen a very strong Q3 GDP print, along with some durable goods and initial jobless claims that came in a little bit better than expected. Now, there is something for everyone with some of the pricing data, and we do have the PCE read tomorrow for September, which will be quite important as well. But we do think that we'll have a more hawkish hold from the Fed next week.
And that's definitely something that will be slightly different, at least in tone, versus what we just saw. Alessio, just sort of wrapping together all of the things that Christine Lagarde was talking about. A lot of people mentioning it seemed like she was more concerned about growth than she was about inflation, that it felt like they were confident they had inflation under control. Is that an accurate assessment?
Definitely the emphasis was more on growth, and growth is what has been surprising to the downside. I mean, European growth is at recessionary levels. It was true in Q3, is probably that's correct also in Q4. However, when you look at the behavior of cyclical variables such as the manufacturing surveys, consumer sentiment surveys, earnings revisions, we are at those cyclical troughs. From here to get worse, we need to get into basically conditions that were more consistent with 2008 or COVID type of recessions, which we don't see in the cards. So from a go-forward perspective, and again, markets are driven more by the rate of change rather than the level of economic activity, we see actually potential for a cyclical rebound, and we wouldn't be surprised if growth were to surprise to the upside relative to current expectations over the next 6 months.
Interesting. Meanwhile, things surprising to the upside, that would be the U.S. Winnie was talking about this. We got GDP out of the U.S. showing the economy growing the fastest in 2 years last quarter. Bloomberg's Michael McKee joining us now with more. Mike, I have to tell you, the reaction in markets was really surprising to me. I expected a pop in yields. I expected to have some sort of bullishness born through in the idea of what does this mean for longer term inflation? Exactly the opposite.
Well, it may be that what Alessio is saying is not the way the market's taking it, that the market is thinking we may see some weaker growth going forward. A lot of people don't think we can sustain this. 4.9% for the third quarter, led by personal consumption up 4%. Now, can Americans keep spending at that rate? Most economists don't seem to think so, although Winnie makes a good point. We do get PCE numbers tomorrow on spending. Here's the real disappointment, though. Business investment down 0.1%. It was up 7.4% the prior quarter. So businesses dropped out. Do they come back? These are questions that are going to consume people going forward, trying to figure out what happens in the fourth quarter. Other numbers today that we talked about, jobless claims up 210,000, still not sending us any signal. Trade balance a little bit deeper, but it does suggest something that came off of GDP a little bit. Durable goods orders, are we seeing a rebound? 4.7% on the headline, 0.6 on the core sort of capital goods orders. And then here, I want to go one more time, Lisa, into this idea of what happened with business spending. If you take a look at the ECAN function on Bloomberg, which is a terrific economic model, it shows you the last 3 quarters and what we have seen. Yellow is the color of business investment. And look at the change. You can see blue, that's what consumer spending is, and obviously it got bigger. But that yellow line is almost non-existent. What happened to business spending, and does it rebound? And do we get some kind of revision going forward that shows it higher?
Michael McKee, thank you so much. Alessio DeLongis and Winnie Caesar are still with us. Winnie, your thoughts on that business investment and how important that is to sustain the kind of growth that we've seen?
I think that it's really important that businesses start to feel a bit more confident about the outlook for 2024. Clearly, the consumer has been doing a lot of the heavy lifting as of late, especially in that Q3 print. And there are a number of headwinds facing the consumer, especially in those lower income tiers where inflation has been the most challenging. Now, we do have a pretty strong labor market, which is going to underpin a certain baseline level of spending for the consumer. But we do expect some deceleration there heading into 2024, which means that businesses are going to have to start to have a bit more of a constructive outlook, which is really challenging when you have volatility, higher borrowing costs, tighter lending conditions, and just a lot of uncertainty around what does 2024 look like relative to this year.
Alessio, what's the most important data coming up for you?
Maybe not data coming out, but I continue to be fascinated by the rise in long-term real yields, and in the context of that, how the employment picture continues to be very resilient. There is so much focus on technical supply issues that are affecting bond yields, and that's all true, that's all correct, but ultimately the clearing price is what the market is giving us. And higher real rates in the long end of the curve, which was completely unexpected by ourselves as well 1 or 2 years ago, is showing that the economy has much more resiliency than was initially anticipated. The economy can sustain, as of today, these real rates. The unemployment rate is still at all-time lows almost globally. And I think it gives us food for thought in terms of our understanding of how resilient the economy can be in the face of tighter monetary conditions.
Alessio DeLongis, Winnie Caesar, both of you, thank you so much for being with us. Coming up, big tech earnings continue missing the mark, but the actual data is pretty good. That conversation coming up next with Dan Ives of Wedbush. This is Bloomberg's The Open. I'm Lisa Abramowicz in for Jonathan Ferro. Let's turn now to the equity markets. Big tech results off to a rough start, at least in trades, with Meta delivering the latest disappointment, the so-called Magnificent Seven, shedding more than $200 billion in market cap due to earnings and threatening to push the NASDAQ 100 into a correction territory. We want to continue that conversation with a long-standing tech bull, Dan Ives of Wedbush. Dan, you know, we talk about the disappointments in the earnings, but when it comes to the likes of Meta, the disappointment was that they aren't sure how macroeconomic events are going to affect the bottom line. What's your take on the reaction in shares to some of the earnings that these companies have put up?
Yeah, I think hypersensitive. And in this nervous backdrop that we're seeing, we saw it with Google as well. But you look at the actual numbers, strong in terms of digital advertising growth. They're ramping up spending, and Meta's in a position of strength rather than weakness. So I think I think we're seeing overreactions in terms of specifically Google and Meta as well. And I think big cap tech, if you actually parse through earnings from cloud to digital advertising, it's strong. And I think that's something that's extremely important going into year end.
With Meta, there also is a concern that the known item on their balance sheet was how much they plan to spend on endeavors that are unclear, whereas the unknown is how much revenue they're going to bring in. How much does that give you a bit of agita?
Yeah, look, I think the agita, if you go back 18 months ago, they were putting good money after bad in terms of metaverse. This is a different company. I mean, Zuckerberg's comeback kid for a reason here. They need to spend on AI. They are in a position of strength to monetize in the digital advertising side. And I think that's the right move. And even though you will see these knee-jerk reactions in this macro backdrop, I think overall, this is something I view as sort of short term. I think tech continues to rally into year end, despite what we've seen here, comes down to the fundamentals. I feel better about big tech post earnings than before, given what we've seen, especially from Redmond in the cloud.
What about, Redmond in the cloud is one thing. Google, though, was a sort of different story, and I'm wondering how concerned you are about the fact that they don't seem to be catching up, at least when it comes to market share, to their bigger peers.
Yeah, look, you don't like Michael Jordan because he's a baseball player. So, I mean, if you look at Google, you own it for digital advertising. That was actually better than expected. When I look at cloud, there's still probably 6 to 12 months from seeing an inflection point there, especially on the AI spend. I mean, obviously, when you compare it to sort of the golden, Redmond in terms of that cloud performance does not look good. But I think that was another overreaction in terms of digital advertising strong and cloud. That's still a business that's massively accelerated over the last few years. I think that's why investors, we've been sort of hand-holding through these numbers. I think there's a buying weakness.
I love the idea of you going around the world, currently in Bangkok, holding the hands of investors and saying, just keep buying. There is a question, Dan, about what we're going to learn today after the bell when we get Amazon earnings. You talk about Google and how it's ultimately an ad spend kind of story. What story is the one of Amazon? Is it cloud? Is it their media business? Or is it the nuts and bolts of brown boxes?
Look, I think from a multiple and from what happens with the stock, it's about AWS, because that's really the golden goose in terms of that success that they're seeing on hyperscale. I think you're actually seeing the next stage of growth in terms of cloud. AI will clearly play into that as well. I think a rationalization on the e-commerce side. I think numbers finally set low enough. And I think Amazon's another. I think that finishes up this big tech week actually on a positive note, especially when you look at the fundamentals going into year end and going into next year. And that's why I believe tech stocks from here are up 15-20%.
You're in Asia right now, Dan. How receptive are Asian investors to the U.S. tech story to continue buying, to continue to invest?
Well, I think the theme here, and I've seen it throughout Asia, is they're selling Chinese tech and looking to buy U.S. tech. I mean, because that's where the trends are in terms of cloud, in terms of cybersecurity, and especially in terms of AI. And you don't have to worry about what's going to come out on a weekend, which is the issue with Beijing and regulators. I actually think there's a huge shift that's going on here. I'm seeing it firsthand. Where is the growth? It's U.S. tech.
Dan Ives, thank you so much for being with us. Wonderful, as always, to get your views. Enjoy your trip around Asia and currently in Bangkok. Right now in markets, you could see a bit of extension of that softness, particularly in the NASDAQ, now down 0.8%, more than the S&P. So despite some of the optimism we were just hearing there and the results, not necessarily hanging in there, the S&P lower by 0.4%. In the yield space, outside of stocks, it is interesting to see yields come in despite the fact that we got better than expected GDP data, the fastest growth in the third quarter in almost 2 years. Yet people focusing maybe on that the Fed, the ECB are done, maybe on the idea that there was a bit of softness in the labor market, a bit. We are not going to know until maybe later. This was Countdown to the Open. This is Bloomberg.